an expansion. All of them, right? You will never find a market consolidating forever. And if you do find a market that is consolidating for a long time or for an extended period, and I say period relative to the time frame you're looking at, even the consolidation, this one over here, for example, has a trend within it, right? But generally speaking, money moves in consolidations and trends, right? That's how the markets are made. How to identify whether we're trending or ranging. There's multiple ways. The way I use is highs and lows, right? So are we rejecting lows and breaking highs, or are we breaking lows and rejecting highs, bearish, or are we ranging, which is rejecting, showing lack of will to break out of the high, right? Showing the will to remain in this consolidation, respecting both highs and lows. It's a choppy market. You wait for a gap in one side before exiting the range, right? So when you're ranging, then you wait for a gap to form, and whichever side the gap forms, that is probably the side of the breakout when paired with a false breakout on one side, right? If you didn't catch the last part, then watch it again. Any given time frame, this is an important concept, so I want to give it its time, which is any given time frame is only bullish until it reaches a higher time frame key level. Any given time frame is only bearish until it reaches a higher time frame key level. And this one is a very important one. I've hinted at it publicly, but this slide you're watching right now, this slide is how you're going to trade and make money even when being wrong on the higher time frame. Pay close attention. If you're listening to it, come watch. Put everything down, take your cup of coffee, and watch closely. Any given time frame is only bullish until it reaches a higher time frame key level. Any given time frame is only bearish until it reaches a higher time frame key level. What does this mean? This means that gaps on the 5-minute time frame will only be respected till we reach a 15-minute key level. Order blocks, up close candles, or down close, on the 15-minute time frame will only be respected till we reach a 1-hour key level. A 1-hour key level. Highs and lows on the 1-hour time frame, we will only respect lows and break highs on the 1 hour until we reach a 4-hour key level. Excuse me. Inversely, a 4-hour key level will be disrespected if a monthly key level is being respected, because in trading, everything can be inverted. Order blocks, breakers, FVGs, even concepts. A famous saying of mine is, every exit is an entry and every entry is an exit. Right? And really ponder over that. Ponder over the fact that every entry of smart money is an exit of smart money, and every exit of smart money is an entry by smart money. Here we have the lower time frame. We are respecting bearish PD arrays, Correct? Bearish premium PDRAs. Premium and discount, it's a long topic. But in summary, don't buy a bullish FVG unless it's in discount. Don't sell a bearish FVG unless it's in premium. Eliminating the FVGs which are bullish, which are not in discount, will save you a lot of trouble. So now we're respecting this premium bearish PDRA. However, we have reached at a discount of this leg, and this leg is more important than this leg because we have a low, we have a high, we have a lower low. Everyone's selling down here, right? And then we have an expansion wave. This is a pattern, but it's also a logic, right? The market makers, of course, when you see the higher time frame, you'll understand, but the market makers sunk price below this low to accumulate as many positions as they want, right? And they will distribute the positions they accumulated below the lows above the highs, one by one, 20, 40, 60. And the market profile tells me we're bullish. Why? Because low, high, lower low, higher high. Expansion wave, which tells me there's another expansion wave due when we reach this breaker. And this is a chart I've called live. It's not some hindsight cherry-picked nonsense. This is a chart I've called live on Twitter for everyone for free. And there was a lot of money which could have been made by this chart. But that alone is not enough. This breaker alone is not enough. If you go to the higher time frame, we're respecting this bearish weekly PDRA, right? Sell, 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 all the way down. You look for weekly open, sell in the wick, down. Weekly open, sell in the wick, down. Weekly open, sell in the wick, and it crashes down. So all during a sell program, you're looking to look for sells. Avoid buys in a bearish trend. And avoid sells in a bullish trend. If you focused more on trend versus counter trend trading, then you'd make a lot more money. And all trends start with turtle soup right here. So the lower time frame is respecting bearish PDRAs. However, we have now reached, on the higher time frame, we've reached a higher time frame PDRA, right? And as usual, rejection blocks give you a retracement before finally targeting the wick. That's another concept. So, are you bullish or bearish here? Pause the video. Think for 5-10 seconds, because that's the amount you should be spending before spotting something for it to be considered high quality. All right. Have you thunk? I know, of course, some of you didn't even pause the video. You were too lazy. But for those who did, your answer should be like this. If we close below this candle, we're bearish. Unless we close below this candle, we are bullish because it is a higher time frame key level. All right, so the concept is bearish on the lower time frame, and we've reached a higher time frame key level. All right, so we reached the higher time frame key level in confluence with a breaker, and higher time frame key levels, which are in confluence with lower time frame PD arrays, are high probability. So we go and crash down into the breaker. We then smack into it real hard, which is what I like to see. When I map a key level and we smash down into it, I like to see that versus slowly sinking and dragging it out, because normally when they drag price and it's really taking its time to reach the key level, then I consider that a less quality setup in general. So we have low, high, lower, low, expansion leg number 1. We've reached a breaker in confluence with a higher time frame key level. We close above this candle. We close above this candle. And from this moment onwards, you have this as your stop loss. The low over here. All right? Some things to note. The important prices to label on this chart when you have a change in the state of delivery is the open and the close. Right? Down close candle. They dug into this low, confluence with this high, closed above it. Candles are ranges. Right? So we have a breakout over here. That's why an order block works. Note this and this. Many a time you'll note this. You'll wait for a 1-minute reaction. It won't happen and you'll say ICT sucks. No, you suck. Because you're supposed to be expecting a deep dig into the order block, potentially the rejection block, and then it goes higher. Whenever there's an order block, always consider the chance that the rejection block does it. Excuse me. And as we see, indeed, we stabbed into the rejection block. Wicks do the damage, and bodies tell the story. We wicked into this order block. We respected the rejection block, because usually what you'll notice is that rejection blocks are usually retraded to more often than not. So if you have a long wick or even a stubby wick, right? If it's not a thick candle and there's any form of wick, then consider that price will go and fill that inefficiency, because that's what it is. It's a form of inefficient price which needs to be rebalanced. Now, next on to the topic of closes versus wicks. Close above equals higher prices. Close below equals lower prices. Wick below equals higher prices. Wick above equals lower prices. In this example, we have a range, prices ranging, right? Now, in every single range, we have a range high and a range low. What does this mean? This means smart money is accumulating. What does that mean? It means they're generating interest